Hello, welcome everybody. Really excited to have you here and to be doing this today. Um, this is a course on trading pullbacks, and this is a pattern that has been so important in my own trading and market analysis. We'll probably actually talk about that a little bit too near the end of the course. That this is, if you understand this pattern, you understand enough about how the market moves to kind of build this big picture technical sense of what the market is, and that lets you do some pretty cool things. This is much more than a trading pattern. Just a quick overview of what we're going to do today, and then the course in general. I want to make a few comments on how we're going to structure the course. So what we're going to do today, we're going to go through to look at what it takes to be a consistently profitable trader, what we're looking for in good pullbacks. We'll highlight 5 common mistakes that people make, probably the most common mistakes I see. I've made these mistakes myself. That's everything we're going to talk about here today comes from both my own experience and 25-ish years of trading now, all markets, all time frames, but also working with a lot of traders. I've seen a lot of people learn and struggle to put this together, and the path to success is not straight. So I think right here at the beginning, in the next hour, I'll highlight some of the common mistakes so maybe you can avoid those. We'll also look at what I think to be the single biggest challenge, and we'll look at a few things that are happening in the market right now. So that's today. But before we jump into that, this is the plan for the next 2 weeks. We're going to have 2 sessions a week, and conceptually, the way I teach is we're going to revisit things many times, and this is deliberate. So don't think, oh, he already said this. Pay attention. If I'm saying it twice, it's very important. I don't think the way we learn something like this most effectively is like you learn one thing, and then you learn another thing, and you learn another thing, and you put them together, and you have success. That's not really the way the human mind. You can learn certain subjects like that, but there is a big degree of pattern recognition and what we would call implicit learning. The only way I have ever seen to do that, and I've also worked in other domains where implicit learning is very important, but it's kind of to circle around. So you'll talk about something here and you'll talk about it here, and then you'll come back and you'll talk about the same thing again, but you're looking at it from a different perspective and you're putting it in a different context. For instance, today in this first session, this is not a theoretical, like abstract. We're going to go through pretty much all of the important points we're going to cover in the course. It's going to be hidden in this first session today, but some of these things we're going to spend a lot more time on, as we'll come back and see. There are points we're going to talk about all 6 sessions of the course. We're going to revisit some things. So you'll see many of the same things over and over. Just know that's deliberate, and that's the best way I found to both teach and learn. Have you had that experience where, like, somebody tells you something or you read something in a book, and then a little bit later you hear it again, and then all of a sudden it's like, oh, wait, I get it now. And then you think, I've heard it before, I've even said it to people, but now I really understand it. So those aha moments of when this comes together, that's the point of repeating information, not to bore you. We actually had to work very hard to push everything into 6 sessions here. So day 2, we're going to spend a lot of time looking at trend structure and how pullbacks evolve in the trend structure. Each of these days is going to have Q&A, and it's also going to have current examples from the market, some of which will be tradable, more or less. Others are going to might be things that just happened and just completed, but we're going to look at what the market's doing right now, and that's very exciting to be able to do that rather than to have sort of a textbook. Day 3, we're going to talk about position sizing, which is one of the I think about the people I know who have exited the business, and that's a nice way to say have blown out their trading accounts and can't trade anymore. The hundreds of people I've known over a couple decades here that have done that. Position sizing is one of the most common mistakes that will lead to that. So this is a very important thing to understand. There are a lot of different ways to think about it, and it's not these aren't trivial answers. What you might do as a day trader is very different than what you would do as a position trader. So we're going to talk about that. Day 4, we're going to look at specific entry techniques, and I'll just let the cat out of the bag here, so to speak. I think that's the biggest challenge of trading pullbacks. And those of you who have traded pullbacks, that's something that everybody struggles with. And one thing to know is it's not that you're struggling with it, it's legitimately difficult because it's something you cannot do perfectly. We'll look at the techniques that I have found useful and talk about how to adapt those in your own framework. We're also going to talk a little bit about options on day 4, and this is something that Tom and I spend a lot of time using options, talking about options, teaching options, and our thinking on how to use options with pullbacks has evolved a bit over the past year. And so I want to share kind of our latest cutting edge thinking, which is actually a return to simplicity. I think it will make some of you very happy. Day 5, we're going to talk about trade management, various techniques there. We'll touch on that a little bit today, and what you need to do to go from paper trading to live trading. Day 6 is going to be a big picture review of everything we've done, but we'll focus really heavily on the Q&A. And for instance, today here in the first session, we'll take some questions, but you're going to have much better questions as we go through the course. So I expect that last day will be very Q&A driven. So that's what we're doing here over the next 3 weeks. Let's start today. So if you want to think about, and I'm going to go through some of this theoretical stuff here at the beginning, kind of quickly. I don't want to get deep down in the weeds on this, but when I thought about building this course, I thought there are really 2 ways to do this. One would be to just show you a bunch of pullback patterns right here at the beginning and say, here's a good pullback, here's a good pullback, and here's how we trade those patterns, go find those patterns. Now, if you think about it, a lot of small trading books are written like that. And in fact, when I wrote my first book, that was the advice some people gave me. One of my mentors even told me that. I was told to, hey, Adam, make a book. Here are my 7 favorite patterns. Here's how to trade it. Make it a 40-page book. And that's what people buy. That's what people pay money for. And there's the key. That's exciting marketing, right? Here's what the best pullbacks look like. Go trade them. But the problem is, if you do that, you're going to wreck yourself. If I could somehow inject into your head here today, this is the best pullback. Here's where you get in, and then go trade them, and you go do that. If 100 people go do that, 95% of you are going to lose money, even if you could find the best patterns reliably. Why? Well, it's interesting if you think about it, right? Because what's the success rate of traders? Depends on the time frame, but it's between 5 and 15%, right? So I still think even being able to identify the patterns, people would make the same. You'd have the same success rate. And the reason is because this stuff we're talking about right now is really important. So I'm not padding anything here. It's up front because it's really important. And some of this we will not revisit in the course, so pay attention. So what does it take to be a consistently profitable trader is the phrase that people like to use. I think it's what you see on your screen here. You have to understand what the market really is. If we begin with a misconception, thinking the market does things, thinking the market works in ways, thinking there are patterns and significance in the market that aren't there, we're doomed from the beginning. So you have to understand reality, and the reality here is pretty harsh, but you're going to understand it here in the next 10 minutes if you don't. And this leads very naturally to understanding what a trading edge is, and then the fact of trading, kind of if somebody said, tell me one sentence, what's the most important thing to know about trading? Well, that's a dumb question, but if I had to answer it, I would say all that matters is what you do. So you can have, and this is in stark contrast to what some of the psychology people tell us, right? Where you will hear you don't trade the market, you trade your perception of the market. So you do a lot of meditation and introspection to understand who you are. I'm big on meditation. That can be another session we talk about. But the bottom line is, all that matters in trading is when you push that button to get in and out of the trade, that you do that on average enough times. So your pile of money you make ends up bigger than the pile of money you lost. That you're going to have 2 piles of money, or you have negative money and positive money, and the positive money needs to be larger. That's all that matters, that you do the right thing more often than not. That's how you make money trading. So the reality of the market, markets exist to find the right price, and the right price might be very different from day to day. You know, it is possible to imagine, think about crude oil right now, which appears to be on the way to making significant highs, if not maybe even all-time highs this year. I wouldn't be shocked. So let's just make up a number. Let's say crude oil is $150 a barrel. It's possible, you can imagine a world where crude oil is $150 a barrel, and then somebody creates, let's say, you know, some verifiable cold fusion or something, right? Overnight, you could see crude oil go from 150 to $30 a barrel. That's almost unthinkable, but the point is, it's almost unthinkable. It's possible. So the point is that sometimes the right price can be radically different from day to day. Those of you who trade stocks, you've probably been kicked in the head enough. You know this, right? An earnings report comes out now, and it comes out this morning, and then all of a sudden my stock is worth 40% more or less than it was yesterday. So the market exists in this competitive environment where people are buying and selling and fighting to figure out what is this damn thing actually worth. And that's another one of the truths of the market, is that this is extremely competitive. You have to know when you step into the marketplace, you're stepping into, in my opinion, an environment which is very close to combat. And I've never served in the military, but I've talked to a lot of people that have, and I've read a lot, which, you know, I know it's very different, but I do think that some of the psychology that we deal with is people are effectively trying to kill your livelihood, kill your well-being by taking your money in the market. And these people you're fighting against, these are some of the smartest people in the world, and they have a lot of money and they work really hard. So it's not easy. You can't just go into the market and take free money, because it doesn't exist. Once you figure something out, and this is one of the magical things about pullbacks. I'm going to tell you one of the truths of the market, which is markets evolve, they change over time, and it's very possible you have a trading edge today, it won't work next month. And it's even possible you have some specific way to trade pullbacks, and the market evolves in a way that will make that way not work so well, and you'll need to evolve a little bit with it. But the very interesting thing about pullbacks, at the same time the market does evolve and change, in the entire history of recorded market prices, and this goes back to Middle Ages and antiquity, we've looked at data from the earliest financial transaction data that people have, and it appears, to the best of our ability, that for us to tease this out, that markets have always moved in pullbacks. And it makes sense if you think about it, right? Because if you're, let's say you're a wool merchant in, you know, ancient Mesopotamia, you have wool, and there's going to be some point naturally where maybe it becomes a little bit scarce, or people need it seasonally, you know, whatever, and people are going to buy a lot of wool, and the price is going to go up, and you're going to be charging more, and then all of a sudden it's going to be too much, right? So this is the psychology behind pullbacks, and this is very, very important, that you have a market that makes a move, and then it kind of gets to be too much, and then there's a natural reaction against that excess. We see this also, not to get philosophical, but this is something that kind of is through all the affairs of humans, right? Everything from fashion, art, psychology, politics, you know, this moving from excess back to a center. So if you build your trading career, you build your conception of the market around pullback, around the idea of pullbacks, you are dealing with one of the very few things that I think has been persistent in financial markets as long as people have been trading. I also suspect, of course, I have no way of knowing this, if you think about the distant future, there could potentially be some evolution that makes financial markets go away, right? One of the big reasons financial markets exist is to find price, allocate resources, and you could have maybe some benevolent AI. What a terrifying thought, right? You could have something that makes this all go away. Until that happens, I think until and unless, I think as long as humans are involved in figuring out what the price of something's going to be, this structure is going to be important. So, you know, if by some twist of fate you're watching this video 500 years from now, I bet you're still able to trade pullbacks. The other thing, and not to get too deeply into this, but trading edges are small. So, there are all these books that come out, like these very masculine titles like Crush the Freaking Market and stuff like that. It's a nice thought, but it's not reality, because those edges where you will have trades where you crush it. We've had trades where we made 30 times our risk on trades, on part of trades at least. But the reality is that because the market is so competitive, those huge edges don't exist with any regularity. If you're making 30 times your risk on trades, you're probably not winning. You're not winning very often. It's just not possible. So the game here is, and the bottom line on understanding the market is, it's difficult to make money in markets. That's not to say it's impossible, but it's difficult. It's also a message if some of you are struggling and have struggled as traders. You're normal. Everybody who does this at some point, hopefully at the beginning, that's the nice place to have struggles, is when you start. Maybe the first few years are very difficult. It's a lot harder to say, put yourself in the position of somebody who got lucky and bought Bitcoin several years ago, and then Bitcoin explodes and you make a lot of money and you think you're a trading genius. If you continue to trade, then you're going to run into trouble. But now you've had this success. So you think, oh, I'm the best trader ever. I made $1 million from a few thousand, and now I can't make money. So now what's wrong? That's very hard to come back from. If you're somebody who has struggled here, even for years at the beginning, just know this is normal. That's the path. Other people are always trying to take your money. This point here, the market is a wicked learning environment. That bears some discussion. So this is technical terminology from the skill development literature, and I'm not going to go too deeply into this today, but basically there are two kinds of learning environments. There's a kind and a wicked learning environment. Many of you know one of the other disciplines that I have some skill with. I'm a classical musician, and I was at one point in my life a decent classical pianist. The points where I could practice 6 to 8 hours a day, those are no longer. But playing a musical instrument is a kind learning environment, because you're able to do the same thing over and over and get the same result. And many athletic pursuits are relatively kind learning environments. If you throw a javelin or you throw a discus, or you jump or you sprint, the result you get is very, very tightly tied to your actions. When you push that piano key, it's the same thing every time. However, in the market, it's anything but. The beauty of the financial markets is that outcomes are extremely random. So you can go into the market. Let's say, again, we have some way to inject in your head and make you a perfect disciplined trader. You can go in the market, you can find perfect patterns, you can do the right thing, you can make no mistakes, and you could have boom, boom, boom. You have 6 losing trades in a row, and you did exactly the right thing. Or you could be a complete idiot, have no idea what you're doing in the market, and you could get lucky and make a lot of money. So this makes it very difficult. I hope you see this. We do need to review our performance. We do need to review trades, but this is the difficulty of that, because you're always fighting this environment where the outcomes are very random. And it doesn't necessarily do a lot of good if you and I were going to sit down together and say, show me your trading record. Let's look at your 3 biggest wins, and let's look at what you did there, and let's do more of those. That's the way a coach would talk, right? That makes sense. And then let's look at your biggest losing trades or your losing streaks, and let's figure out what you were doing wrong, and let's not make those mistakes again. Okay, except what if it wasn't you? What if it was the market? What if on those biggest winning trades, you got lucky? What if you did nothing wrong and you just went through a normal drawdown? So you see, it's actually very difficult to learn from the market, because even if even from my vantage point, which is, I don't know how much market data I've seen. I've looked at certainly hundreds of thousands of charts in my life. I placed tens of thousands of trades. I've watched markets, every single tick of markets while they're open. I've also looked at the weekly, monthly perspective. I've seen this entire landscape of trading, and even with that experience, I do not have the confidence that I can untangle this with any degree of reliability. So what's the solution? is if you're evaluating your results, you don't look at the highlights and lowlights. What do you call lowlights? You look over a large sample of trades and you understand where you're tending. And you might look at the outliers too a little bit, but you're going to view those with suspicion because you know this is a really hard environment to learn from. That's a point that we're probably not going to come back to very much. I said we'll repeat a lot of things, but if you're watching the replay, or if you're thinking about this, or if you're taking notes, I would encourage you to do some thinking on what I just said. Write down wicked learning environment. Go Google that and you'll find a lot of other resources. And the good news is there are other environments that are like this, and people have spent a lot of time figuring out how some people spend a lot of time figuring out how we can achieve the consistency that's possible within a wicked learning environment. But I would also encourage you to read what other people have thought and said about this, because there's a lot of intelligent people addressing this. One of the other things I said at the beginning that, if you asked me what the one most important thing was, and I would respond, that's a dumb question, because there is no one most important thing. That's also true. Everything matters. There are people who will tell you that, position sizing is the most important thing. Psychology is the most important thing. Entries are the most important thing. Risk management is the most important. You go on and on and on, right? Portfolio construction is the most important thing. All of these things are important. The way I think about it is, okay, you have a high performance jet airplane. What do you want? What's the most important thing? You can have control surfaces, you can have landing gear, or you can have an engine. Which one of those do you want? Which is the most important thing? Well, obviously, you have to have all those. And that's exactly the way trading is. All of those things I listed and more have to be working, and have to be working correctly if you're going to be successful trading. It certainly can be the case that, and it typically is with struggling traders, that you're doing 19 out of 20 things correct, and that one thing you're not doing quite correct, quite correctly, that's the one thing that's holding you back. So, and this is a logical outcome here of everything we just said, right? If it's so difficult to make money trading because the market's so competitive, yeah, on and on, then it becomes very obvious that all of the details are very, very important. And not to belabor this point, but every trade is a random outcome. We could say a lot more about a random outcome from an unknown probability distribution, but let's not get deep into the numbers now. Just know that every trade you put on, look, I'll tell you my mindset. Here's one of the keys to my trading psychology. Every single trade I put on, I assume it will be a loser. And it's probably a little bit baffling for the people who have traded with me, because I'll say, look, this is like the best pattern I've ever seen. This, whatever, I'm very excited about the trade. And then as soon as I put the trade on, I think, and I start talking about it like it's going to lose. And that's not pessimism. Actually, I think there's a lot of value in being an optimistic person, big picture, but it's a quirk of psychology that reminds me that even if I do everything right, the outcome of any one trade is random. Now, by the time we're looking at 10 or 20 trades, we should start to see some results. So what you need to trade successfully: you got to know when to get in, you got to know when to get out. And knowing when to get out includes both getting out at a loss, and I've used the abbreviation here, stop loss, or when you get out at a profit. I've said take profit. Furthermore, getting at these subdivide a little bit too, because getting out at a profit could be an initial, and I write very badly on the screen, so I'm not going to try very much, an initial profit target, or it could be some kind of trailing stop. I'll just write T. Stop loss, you have that initial stop loss. You also might have a tightened stop loss. You might have a break even at some point. You might have a time stop. There are different ways to do this, but you definitely have to know, in addition to getting in, when you're getting out and all of the possible paths that can take. You got to know how to find good trading opportunities. That's something we're going to talk about a lot in this course, because one of the challenges, a little bit of history lesson, my history. So I started trading futures, and there really aren't that many liquid futures you can trade. I suppose if you wanted to look at different months and trade everything possible, domestic US listed futures, maybe you get up around 40 or 50. Most futures traders follow less than 20 markets and do very well. So it's not a huge universe. Then I traded currency futures specifically, and then I traded S&P futures. And then there was a glorious moment in my evolution where I said, let's trade stocks. Okay. And all of a sudden you discover, what? There's like 7,000 of these things. And then, you're like, okay, well, most of them aren't very liquid. They don't trade. So, okay. And then you eliminate those. And you're like, what? There's like 2,000. So what are you going to do? Look at 2,000 charts every day? I did that for a few years. I would not recommend it. So you have to have some way to know where to find the best trading opportunities. And that's a little bit different by asset class. That's something we're absolutely going to talk about here. You also have to know how much to trade. There are, this is one of the trading questions for which there are pretty well-defined right answers, and we're going to talk about that. And then you also do need psychology. I throw a lot of shade on market psychology, and the reason is not because it's important. It's critically important. For many traders, after you learn all of this stuff, kind of the last thing they struggle with, the last thing that stands between a trader and real success is trading psychology. It's critically important, but the question is, where? Where does it come in the learning process? And you go into Facebook trading groups, for instance, and you're going to find probably well-intentioned people tell you that all that matters is trading psychology. Well, that's obviously a stupid thing to say. And when I think about how stupid it is, I have to restrain myself from spewing strings of four-letter words. It's unbelievably stupid. Why? What if your heart surgeon thought that for surgery, the most important thing is just how he felt about it and his mindset and his personal conception of how the body works? Well, or your airplane pilot thought that, to go back to that metaphor, right? It's obviously not very effective because there are some realities we have to deal with. So I think a lot of people put psychology in the wrong place. Psychology is what stands, in my understanding, between the mental conception of what we should be doing and what we actually do in the market. Psychology sits in the middle there. So it's sometimes a roadblock. It can be transformed into a bridge, into an enabling thing, a powerful enabling thing, but it's not at the beginning of the process. And then again, just here's a little deliberate repetition. All that matters in the end is when you do the right, you do the right thing at the right time. Just a couple words on probability here, and then we're going to start looking specifically at pullbacks. Every trade is random. I talked about that. I cannot emphasize that enough. If you were to, let's say you were going to evaluate the success of today based on the success of a pullback pattern. You might, if you were completely new to trading, this is a reasonable, deeply flawed, but a reasonable line of thought. You'd say, okay, Adam understands pullbacks. He's teaching pullbacks. He's seen a lot of these over the years. So how about, Adam, you show me what you think is the best pullback pattern, and then I'll come back in a few weeks, and if it was a good trade, then I'll buy your course, whatever. I'll pay attention to what you say. And if it's a losing trade, then obviously you're an idiot. I'm never going to look at anything you ever say again. That would be, in many disciplines, we might think it's a reasonable way to think. But the problem is that even if I give you that best pattern, and I'm going to, even if I give you that best pattern today, we'll look at it at the end of the course, at the end of the session, the outcome is still random. The best pattern can fail. And what you should not see is the best patterns over a period of time, or the best set of patterns in uncorrelated markets. You shouldn't see that most of those fail in a way that costs you money. Again, the pile of lost money is bigger than the pile of made money from the pattern. So I didn't say that very well, but I think you get the idea that to really understand this, you have to start thinking in sample sizes, and that's one of the keys. Also, one of the keys to psychology too, by the way. Strings of wins and losses are common. And so that's a nice abstract thing, right? If I'm standing up in front of a classroom with a blackboard, I would say, be prepared. You will have strings of winners and losers. Next topic. Well, from someone who's lived and bled down in the trenches, let me tell you, strings of wins and losses are common, and they suck. They can destroy you. Those times when one of the other truths of the market, look at your screen here. So pretend this is an equity curve. This is what we wish our trading account looked like, right? You start here at 0 profit dollars. You end up here at the end with multi-trillions of trading profits, and it just went straight up. That's not reality. A real trading equity curve looks something like this. And it might look different a little bit, but the point that I'm making here is that these drawdowns, and what I mean by drawdowns, remember what we're graphing here, this is not the market, this is your trading account P&L. Drawdown is times when your trading P&L is not the highest it's ever been. Here's one of the truths of trading. Your account's usually going to be in drawdown. So those days that you come in and you're like, I'm at a new equity high in my account, you'll have those days. You're going to have many more days where you're like, I'm X% off that high. That's normal. Your account is going to be in drawdown more days than not. That's the reality of every trading system. Anybody who tells you otherwise, there are two possibilities here. Either they are an algorithmic trader working with very high frequency data and probably co-located with an exchange. And keep in mind, this is not something that somebody is doing with Python at home. The people who do this literally pay extra money to have a copper cable that's a few meters shorter, so they're a little bit closer to the server. That speed difference matters. And if you think about the speed of electricity through a copper cable, you can see that that's a very slender edge. Those people sometimes will have equity curves that are pretty straight. The other way you can have a straight equity curve is to trade against your customer accounts. And a lot of the big institutions do this. When you hear that such and such bank had their first trading loss in 385 trading days or whatever, well, that probably tells you they're trading on some information that the rest of us don't have access to. But if you are a normal trader at home, your equity curve looks something like this. It might even look something like that. Be prepared for this. If you don't know this, it's very, very hard to deal with. And these strings of wins and losses are critically important to expect and understand, because if you're in the strings of losses, you're going to feel like a pretty bad trader, and maybe you're not. If you're in strings of wins, you're going to feel like a pretty great trader. And at least in my experience, for me, that's more dangerous, because you start thinking, I don't really need to follow my rules. What's this risk management position sizing business? I'm obviously the best trader ever. Why don't I just go big? So that, and you can see that's how you get into trouble. It's also very easy to attach meaning to random events. Let's say people can do this in a lot of ways, but I think this is why there's so much, I don't know exactly what the word is, but so much weak thinking in a lot of technical analysis. People don't understand that just because two things happen together doesn't necessarily mean they're tied together. And the goal here, and this in fact this has all kind of been an intro to our course, the goal is to find a trade that you can do over and over. And if you were looking, when I used to interview traders, potentially hire traders, one of the questions I would ask is, why do you want to be a trader? What's the standard answer? What would you answer if I asked you that if you were applying for a job? Why do you want to be a trader? Well, here's the wrong answer. I want to work in a fast-paced, exciting learning environment. Oh, okay, you can have that. Here's how you have that. Open a trading account, risk 25% of your account on every trade. It's going to be very exciting. And it's going to be a very short career probably, but eventually, if you do the wrong things. Oh, and also while you're risking 25% of your account, why don't you force some trades? Why don't you double down on some losers? These are all ways you can make a very exciting trading career, but I hope you see that what I'm jokingly saying here is that that's the way you destroy yourself in trading. And the reality of this, one of my mentors said, at a point when I was switching markets and struggling. And by the way, that's also normal. If you switch approaches, if you switch markets, I know, for instance, let's say I were to go into, I don't know, like day trading cryptocurrencies, for instance. If I was to step in that environment, I'd struggle for a while. And maybe there wouldn't be an edge there at all. But even though I've day traded, I have traded cryptocurrencies, just looking at them from that different perspective would be enough of a new thing that I would struggle with. So I was struggling, and I had this discussion with my mentor, who was an old bond trader, and he said, Adam, he said, the people that I used to have working for me, but on the floor, I used to train a lot of traders. He said, I would tell them that trading is a really boring job. He said, the closest thing I can imagine is being a bricklayer. And he said, think about that. What do? You have a brick, you put the brick down, you put mortar on it, you put another brick down, and you're doing the exact same thing over and over. And it's probably not very exciting to put bricks down over and over, but you do it every day, and eventually you build a giant wall. And that's the way trading works. You're looking for that. So that was his bottom line advice for me. He said, if you want to be a trader, be a bricklayer. That's how you need to think of yourself. That's how you need to think of trading. Be a bricklayer. And that's what we're looking for here. We're looking for a trading pattern, a trading idea that we can execute over and over. And that's why we're talking about pullbacks. What are pullbacks? Pullbacks are pauses in trends. Now, that's the key to trading pullbacks. However, it's a little bit harder to implement than that. Go look for trending markets and trade pullbacks. Problem is that you can put these trades in different places. You can certainly trade in the middle of the trend, which is probably what most people would assume. It's what I would assume. If you tell me you're looking for pauses and trends, I would say, okay, so you got your market here, your market's kind of doing its trending thing here, right? So we're going to wait until the market's trending, and then we're going to look for these. Look, I just kind of naturally drew these little pauses and trends, and that's what we're going to trade. Okay, yeah, that's certainly one way to think about it, but it's also possible to trade at the beginning of a trend, and there are things that can be done and things we need to be aware of at the end of a trend. So it's not just enough to know that you look for a trending market and then you look for pullbacks. You have to understand how this works and the complexity of the structure of the trend, and that's what we're really going to focus on in the next session. But we'll touch on it here today. Pullbacks also tend to be controlled. And what I mean by controlled is relatively lower volatility and volume. We can talk a little bit about volume. It's not something, these two things are quite tightly tied together. And my focus tends to be much more on volatility, to the point that I don't even look at volume in my own trading. And well, we can certainly talk about that, but this is also important. Pullbacks are pauses in trends, and they tend to be controlled. Biggest challenge in pullback trading, I think there are two of them. One is knowing precisely where to get in. This is a source of constant frustration, even for successful pullback traders, because there's no perfect solution. If you are the most skilled pullback trader ever, you will still have cases where you are in trades early, where you're in trades late. And here's, for many people, the most infuriating thing about pullback trading. You're going to be stopped out of trades. You're going to have losing trades that end up working. And what that looks like is you have a market that's trending here, and it rolls over into a pullback, and you buy it. And then it goes up, and then it kind of goes flat, and you get stopped out. Let's say you get out here. So you got in here, you had a losing trade here, and then what happens? The damn thing goes straight up. That happens. That happens to the best pullback traders. It's just one of the reality of pullback trading. So you got to know that that's the big challenge here, knowing where to get in and knowing how to limit risk on entries. Because what you can't do here is say, okay, here's a market, goes into a pullback. I'm going to buy it here. And well, it's a pullback. And Adam said pullbacks are the best patterns. And so I'm just going to hold this. And in fact, I'm going to buy more when it goes down, because sometimes this happens, right? Where you thought it was a pullback and it turned out that it was actually the beginning of a significant decline. So what you have to do is find the approach that works for you. We're going to talk about that, and you have to be consistent within that approach. Now, what's it mean to work for you? A lot of people will say, hey, anything works. I think that's wrong. I think it's almost exactly backwards, because the reality of trading is, and those of you who have struggled with trading for a while, you know, the reality is that almost everything you try does not work in the end. The reality is that a lot of different things work, but there are many pieces here, and they will only fit together in certain ways. For instance, let's just imagine, think about your entry technique and exit and stop loss. Let's just think about those, right? So let's say you have an entry technique where you get into the market, let's say relatively easily. So you don't need much information to get into the market. And I'm oversimplifying here, but I think you'll see the idea. And then let's say you have a stop loss methodology where you get out really slowly. So that's probably not going to work, because you're going to be in many of those situations like I just drew on that previous slide, where you're buying here and you get in, and then the market comes down, keeps coming down, and you're still in the trade because you're not getting out. On the other hand, if you were in, if you have a system where you get in very easily, and then you have a market that doesn't give you enough confirmation so you get out, that's probably going to be better. Now, consider that you have an entry technique where you require a big pullback or a lot of information to get in. You can see, so what I'm talking about here, and maybe not the clearest way, but I hope you get it, is that you're going to have to tune those two pieces of your strategy to work together. It's pretty obvious that if you're requiring big pullbacks to get in, you probably need a little bit more. You probably need a little bit more of what's the word? Not disconfirmation. I don't know, my brain made that word. Contradiction. That's the word. You're going to need a little bit more contradiction to be forced out of the trade. So you can see that with just these two pieces, but the reality is there's a lot more than two pieces, right? So all of these pieces of your trading approach fit together in different ways. Now, it's certainly possible that we could say, hey, let's change this piece. Here's your entry technique. Let's change it to be this. That's if you're going to continue to trade profitably, you're going to probably have to also make adjustments in how you get in at a profit, how you trail your stop if you trail a stop, how you get out at a profit, where you put your initial stop, maybe even your trade selection. Yeah, as you tweak one thing, you're gonna have to tweak other things. So this is why it's very important to be consistent in your approach, and it's also important to fine tune a system so that it matches your personality. That's a real thing. You know, some traders, for instance, my personal approach is it doesn't take me much to get into a trade, but I also get out of a trade very easily because I know that my framework is that it's probably going to be a losing trade. So, I'll see a good pattern, I'll get in, I'm like, oh, it doesn't look good. I didn't think it was going to be good anyway because it's probably going to be a losing trade. That's the way I'm wired. But if you're the kind of person who has like real conviction when you get into a trade, you probably can't get into trades like I do. So you have to figure out, I'm also comfortable with, kind of a 50-50 win rate, ideally a little bit better, but I'm not a trader who needs an extremely high win rate. I'm also not a trader who's going to be too happy with a typical trend following in the branded approach, a turtle style approach where you might have 15 or 20% winners. That's not really how I choose to live my life, for various reasons. So you do have to figure out what works exactly right, what feels exactly right for you. Let's look at some examples of bad pullbacks here. So, and again, we're definitely covering things that we have not covered yet deliberately, but we're going to see these things over and over. So this is a market. This is the stock First Solar, and you can see through this period here on the chart. I'm going to draw and erase quite a bit, so keep an eye on this chart. The market was trending. And if we were to highlight pullbacks, and this is always easier after the fact, that's a lesson. I'll go through and just kind of highlight here. These are points where you might have looked reasonably to short. You might even have had a short here. So these are all pullbacks that might have been tradable. I think some of them are probably tradable in hindsight, and may not have been tradable in real time. That's something you need, of course, to be aware of. You need to be very suspicious when anybody puts out a book, particularly those like bar by bar trading books where you're supposed to get all this information out of each bar. It works great if the author can go back and say, you know, here's the price history. It's a lot harder in real time. I'm not saying it's impossible, it's a lot harder. But look here. So is that a pullback? Well, now you can see what happened afterwards. It turned out to not be a pullback. But this is an example of a market where if you look at this action here, so theoretically, this is a pullback, right? The market made a new low and then went higher. So this is, if we're looking to trade pullbacks and downtrends, this is what they look like. And pullback here, right? But this is not a great pullback because the character of the market totally changed. Look what happened. This series of up bars is unlike anything we've seen in this whole history, right? So this is an example of when you get this kind of signal from the market, you don't want to look to trade pullbacks after those kinds of moves. Another example of a bad pullback is, this is another stock, this is Kroger. And so the stock that was kind of doing its uptrending thing through here, and then, you know, not every part of the market is easy to read, and then boom, it exploded to new highs. Exploded to new highs on some pretty extreme volatility. Look at the size of this bar and this bar. And if we look at the size of this bar, let's fill in that gap. That's what true range would do, right? So look at these three bars, compare them to the bars here. How big are they? I don't know. I mean, like just eyeballing it, what are those, 5 or 6 times? So volatility has exploded. It's 5 or 6 times what it was before. Volatility is one of the most important things to understand about the market. So when you see this, when you see a huge explosion of volatility, that is potentially climactic. And that's a word you're going to hear several times. You're going to hear it a lot in the next session. You're going to hear it a lot today too. So looking for a pullback in this area following this climax is a really bad trade. In this case, look, in this case, if you had done this, so I'm telling you that this area is a bad place to look for a pullback. Now, you might be scratching your head because you might say, well, Adam, if I had done that, I would have had a winning trade. This stock went on to make a new high. You are correct. Why did I pick this example? Just to illustrate that even if we have the right principles working, and I'm telling you that if you do this trade many times, buying a pullback here, you will not make money. Even if we have that working, then you can have a different outcome. In this case, you would have had a winning trade. So what if, except what I'm telling you here is true, but what if you made a lot of money on this trade and you didn't know any better, and then you made it your mission in life to find similar patterns and trade similar patterns? You're gonna end up in trouble. So another example of a bad pullback here, this is crude oil. This is crude oil in response to the Russian invasion of Ukraine, had been doing its uptrending thing, and look what happens. Boom, big move up, right? And then what? Big move down. So one of the principles of a market is that when you have a big move up followed by an almost or an equally big move down, the likely outcome is consolidation. Some kind of triangling, some type of contraction of swings, which is exactly what you had here. Now, there are ways we can trade this. We actually think this is pretty well set up for a long trade now, but this came after many, many weeks of this sideways stuff. If you were to look to buy a pullback here, big move up, giant move up, giant move down, that if you look to buy that pullback on that giant move down, it's not a good trade. Why is it not a good trade? What did I say about pullbacks? Pullbacks are generally controlled. Does this look controlled to you? If that's your definition of controlled, right? So that's another example of a bad pullback. And one more here. This is the US dollar futures, not really a market that we trade a lot because we trade the individual currencies. But if you were to look to buy a pullback here, it's also not a good trade. It's a trade in this case that worked out. But the point here is that this was a market that actually had given us some signs of trend ending. We had 3 pushes up, and then we had there's a common thread here. That's not a particularly controlled move. Now, look, it's not the same as this, right? This is a collapse from, on this chart at least, it's continuous, but a continuous futures from, let's call it 125 to $90. This is a big move. This is not, let me erase here. This is not such a big move, right? However, look at it in context of these previous swings. And then you have this, that's not a controlled setup for a pullback. So that's not the kind of thing we're looking at. I do want to be clear here. When you're reviewing the video, all 4 of these trades I just showed you, these are examples of the kinds of trades that we avoid. These are explicitly not good pullbacks. And this leads to the 5 most common mistakes that I have seen traders make in pullback. One, I tell you this, my very first trade ever was mistake number 1 here. So I loaded up a trading account and got ready to trade. I'd learned to read charts. I learned a bunch of patterns. And I was ready to go. This is in the mid 1990s. And I waited for wheat to make a big move to the upside. And then I bought what I thought was a pullback. I was wrong. But this is one of the most common beginner mistakes. If you're just looking at a market that's just doing its little trending thing, right? This isn't very convincing. But if the market goes like this, you're like, oh, now everybody knows, and plus all the news, all the media is telling you that this market's going to go up forever. So you're going to be very tempted to buy here, and with a high degree of reliability, that's where it collapses. So this is one of the most common mistakes, people looking to trade pullbacks. They're not pullbacks after climaxes. And this is something I'm going to hammer into your head, especially in the next session. Trading too big, it's the best way to destroy your trading account in 1 or 2 trades. Being too early or too late, we talked about that. We're going to talk about that a lot more. Also, overstaying your welcome. I'm going to show you some examples of each of these, and ignoring failure signals on entries. Just to drill down into these a little bit deeper. Most of the examples I show you, I'm going to try to have very like right edge of the chart, but not all of them, because sometimes some of the best examples come from market action in recent memory. And this is the S&P 500, hello, on the COVID decline. This is the COVID decline. For some of you traded through it, some of you maybe knew enough that you didn't live through this piece of market history. But if you were looking to trade pullbacks in this area, look here. So this is a tradable pullback. You might have had enough of a pause here to get some shorts on. And you might even have been thinking in this area to think about pullbacks. But this is problematic here, because you've just had some evidence of a climax. Now, to go back to this time in market history, personally, I thought the market would decline a lot more. I did not expect at the time this recovery, and then for the market to be much higher in a matter of a few quarters. That was not what I expected. So I was definitely looking for opportunities to put on shorts here. And those of you who are Market Life members, you have access to the archives. You can go back and see what I was saying at the time. And that's the beauty of doing daily market analysis. I can't make this stuff up. And there are times that we have the wrong big picture framework. It's unavoidable. However, what we did not do was burn a lot of money putting shorts on here, because we were looking for the right kinds of patterns. We were looking for some stabilization, which would have given us indication that we might have had setups for shorts. And instead, we saw this action highlighted this clearly as a climax. So we were able to avoid losing trades. This is just one of the most recent examples of market climaxes, but certainly over the next year, we will have other examples. Climaxes are hard to deal with, mostly because of psychology. So one of the things I think about with the market is you're going to be emotional when you interact with the market. There's this idea that we would like to be unemotional, but the reality is you are going to be emotional, because every trading decision you make is a combination of rational analysis. It's not a trading decision, but every decision you make as a human being is a combination of rational action and also emotional content. That's how we process information as humans. And you can balance these things, but you can't eliminate emotions. The market, the moves of the market are engineered to create emotions in you. So if you've been trading and you discovered, wow, this is an emotional roller coaster, again, you're normal. This is what the market is supposed to do. And there's a lot of theory we can go into behind this. Psychologists have actually studied this, and I'm not just telling you something casually, that the market is engineered to make you emotional. One of the most emotional areas in the market with consistency is the climax, whether to the upside or the downside, because you get this fear of missing out. You might feel like you just missed the move, and you can easily say, hey, this thing's going to go, while crude just went to $110 a barrel, it's going to go to 300. I got to buy now. I got to buy now, or I'm going to miss the move. That's the psychology. And we are all vulnerable to that. This is why we're going to emphasize the dangers of trading around these climaxes so much. Also, volatility, excuse me, is a double punch. What I mean by this is that if the market's swinging a lot more, and we saw in one of these previous examples where volatility is 5 or 6 times what it was before, right? So if that's the case, then your position size is going to be a problem, because you can put on the same size position, but if the market is much more volatile, it has a much bigger impact on your P&L, and your stop is also more likely to get hit and even slipped. And this can happen even if you're an intraday trader. You can have slippage on stops in some markets. So I would say, particularly if you're a developing trader, there are trades that we can put on around climaxes, but particularly if you're trying to figure out, okay, just how do I get my hands around some money that I can take out of the market, I would probably tend to avoid climaxes. So I'm going to reemphasize that point because I think it's very important. Trading too big, as I said, it's the easiest way I know of to destroy a trading account. This is how, and I've seen people, just cautionary tale here, where you really get in trouble is with things with open-ended risk, like selling options. And I knew a guy who lost his house, lost everything, because he was convinced that the S&P was going to do something, and he sold a boatload of options, and S&P didn't do what he thought it was going to do. And so had he had that conviction and then executed his plan, he probably would have been okay. With proper risk management. But the problem was he went all in. And as the old trading saying goes, if you bet the farm, eventually you're going to lose the farm. And so just the one thing that I would tell a developing trader, and even if you're an experienced trader, if you have not thought about these patterns the way we're talking about them, you're still a developing trader for the purpose of developing the skill of trading these patterns. Stay small. In fact, maybe stay zero. And then once you start putting risk in the market, put on small risk, put on small trades, don't risk much. Make yourself earn the right to trade bigger. And then once you do have that right, then you got to figure out what the optimal answers are. And it's certainly not risking 25%. Kind of the bottom line, it's not on the slide, but I'll tell you, the bottom line with position sizing and with the whole discipline of risk management is you want to make sure, as sure as you possibly can, that no one trade can take you out of the business. That's what you're looking for. You're not looking to make a single trade where you are able to retire in glorious showers of money after the single trade. That's not the side you're thinking on. The side you're thinking on is, I don't want a horrible trade to be able to make it so that I can't play this game again. This is the best game in the world. This is to have the privilege of sitting down in front of a screen and to be able to sit in the comfort of a desk or an office or your sofa, and to be able to push a button and to compete in this incredible game is a privilege that really should leave all of us a little bit more awestruck a little bit more often. So what we certainly want to do is to make sure that our own stupidity, and we keep in mind we are all possible of impressive stupidity, our own stupidity combined with the vagaries of random outcomes in the market, that those two things are not capable of taking us out of the business. You don't want to lose the ability to trade. And that's why position sizing matters. Being too early or too late, as I said, this is what is too early or too late. Well, you can't be perfect. You are going to be early, you are going to be late. And I will tell you, for a developing trader, being too this is actually a mistake on the slide. We will fix this. I'm going to fix it here in my extremely awkward handwriting. Being too early is probably more common because you have FOMO, you have fear of missing out. You got to get in the trade. You got to get in the trade. So you're going to be tempted to just jump into all of these trades because you're very nervous and excited about the market getting away from you. And it's possible to be pretty early getting into trades and be successful, but particularly for developing traders, watch yourself for that tendency. If you have any sense of, I got to get in this, I got to be in this, you're probably on some kind of shaky ground, and it's nothing more than fear of missing out. And the best defense for this, the only defense for this I really know about, is having a disciplined trading plan and being prepared to miss some trades. I miss trades. We miss trades with, we do very little outside of watching the market for the best trading opportunities. Like, that's between me and Tom. That's our reason for existing at this phase in our lives. And we still miss trades. You are going to miss trades. And you just have to accept this will happen for various reasons. It might happen because the trade wasn't actually as well set up as you thought. It might happen you just missed it. It might happen that you were looking at something else. If there are, for instance, let's say I think big bank stocks are going to make a move, and it might be that I'm watching, I might be watching 3 of them and the 4th one makes the move, and so I missed that move. Or, so that you can see, I could go on and on. I can come up with 2 hours of ways that you might miss some trades. But the point is, you have to be prepared for that, and you can't beat yourself up for missing trades unless you're missing trades for the wrong reasons. Overstaying your welcome. Well, this, an example here is like, let's say you buy, this is not a traditional pullback, but let's say here with Bitcoin that you bought here, or actually pick your spot, right? Let's even say you bought here or you bought here. So you see there are several reasonable places you might have bought on this chart, but at some point you have enough confirmation that this market is no longer trending that you got to start thinking about your risk management. And I think that cryptocurrencies, that this is right now, as I'm recording this in 2022, this is certainly one of the markets where people are struggling to understand, how do we think about these markets? Why are we in these markets? Where do we get out of these markets? And I suspect, my personal opinion is, and many of you are going to disagree with this very, very strongly, I think we're probably headed to see some more significant weakness in cryptocurrencies. But, depending on your perspective, what might be overstaying for me as a technical trader, if I were long, I'm certainly overstaying right now. But if you're buying for other motivations, you might not be overstaying. So this is where, again, we get back to the way that people see markets from many different perspectives, and there really is no one answer. However, not all answers are right, and there is one answer for you. If you are in something because of deep fundamental macro convictions and you're getting out because the market makes some little technical move against your position, that's probably not very smart. So you would have to put that conviction together with a different exit strategy. Failure signals on entry, we're going to talk a lot more about this, but just imagine that you shorted this market here. And I might argue this is Bitcoin again, I might argue it's not a particularly good spot for a short, but isn't it pretty clear here that your short was pretty wrong, right? So, this is an example of a very, very clear exit signal, and your stop would very likely be hit on something like that anyway. Look here, let's say you bought Bitcoin in here, and then the market obliged with 2 big rally days, and then this is a daily chart, and then you had this period of weakness. Well, that's pretty big confirmation, isn't it? Especially coming at highs that you probably don't want to be long, and you certainly don't need to be long through this. So this is an example, and you will see this, and you probably will even do it. If you bought Bitcoin here based on this pullback pattern, okay, it's a fine trade. If you're still holding long here, you have a problem, right? You missed something. So, the question, of course, is where exactly do you get out? And that's something we will have extensive discussions on, but that is one of the more common mistakes that people make. So, quick review here. We looked at what, and I'm going to encourage you, I think probably the best way, if you have seen this video once or you were in the session today, I would go back and either watch the video again, you can speed me up so I talk faster, or I could mess with you and talk different speeds in the presentation. Then you wouldn't know what to do, right? Or maybe just drop the needle, so to speak, at different points and listen to some of the sections again. I think it's very important to take notes, and you might even want to come back to day one, some areas, some sections of this as we work through these other days too. But so we looked at what it takes to be a consistently profitable trader, and kind of the bottom line there is that you have a lot of pieces that have to fit together. There's no one simple answer, and the reason traders struggle is because truly everything is important. We also looked at what we're looking for in good pullbacks. We saw some bad pullbacks. We're going to see and that's not the way we're usually going to teach this. In the next session, we're going to start to really focus on good pullbacks. We looked at the most common mistakes people make and the 2 biggest challenges, which really tie into managing those entries and managing risk. Let's look at what's happening in the market right now. So this is what I think is one of the clearest and best pullbacks. This is Treasury futures. We're looking at the 10-year notes. You can look at the 10s, the 5s, the 30s. You could also look at Euro bonds, and you're going to see similar structure. One of the things you have to know about interest rate futures is they tend to trend quite well. So you will, a stock will tend to make a move in reverse on you. If you have, let's just look here. Let me highlight some of the historical pullbacks on this chart. And again, I'm not saying that all of these were tradable. Some of them were beautifully tradable. This one's a bigger one that might not have been tradable. What's that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So there's at least 11 pullbacks to the short side. No long pullbacks here. And now we're looking at maybe the 12th pullback in a row in the same direction after many months of a market trending. That's a little bit unusual, but interesting thing here. This is a complex pullback. This is a 2-legged pullback, which, so, pullbacks can look like this. This is the pullback. And by the way, this was deliberate. You haven't seen these kinds of diagrams yet. I haven't showed you simple examples of here's what a pullback looks like, because this is the way we wanted to layer this. This is a complex pullback. A complex pullback, the pullback itself has a little pullback in the middle of it. It's a pullback with a pullback against it. These are sometimes frustrating to trade, but look at this structure here. And do you see that here? I'm going to clear these lines. So look at the chart, see, make sure you see what you're looking at. And do you see this here? So you have a 2-legged pullback. We might also define this structure with lines that I've drawn freehanded like this. There are all kinds of momentum divergences, which we're going to talk about. I don't find momentum divergences to be a particularly compelling signal because they don't work as well as people think. Here's, let's look. This is not the topic today, but let's look at some other momentum divergences. I'll just highlight, well, that's not one. I can't really erase that. Momentum divergence here. Momentum divergence here. You see the point, right? That even though the market had made multiple momentum divergences, it still continued to trend. And so that's why when you have here, what, 1, 2, 3, 4, 5, half a dozen failed momentum divergences, I wouldn't be too terribly concerned about a momentum divergence here. You do have some type of rounding bottom here, some bigger picture evidence of losing momentum. But given the tendency of Treasury futures to trend, this is definitely a market that we would look at for short entry. So this is something that, as of close yesterday, was a potentially actionable pattern. Here's another one of the most important pullbacks I think we need to be aware of. This is the Russell 2000. Now, this is not necessarily an actionable pullback. What we're looking at is this. This is, however, not to pat myself on the back, but we've been on the right side of the market, the big picture, with, I even hate to say something like this, but with astonishing regularity. We've been right. And this has been one of the patterns that has kept us on the right side of the market. We noticed that, and apparently many people missed this, the Russell was in a range through all of 2021. And then we had a failed rally attempt here, around Thanksgiving. And then we came right down and broke out of the lows. This is a measured move objective move, which we're going to talk about. But then what happened? We set up this consolidation under the 2021 range. And now we've had a breakdown. This is a move that typically, what I'm drawing here is schematically, don't take any specific price levels there, but this is a move that typically leads to more and more selling pressure and further legs down. So this is why we think we are in, at best, a neutral market environment for stocks. We think the people who have been in the mode of buy the dip, which, by the way, has been the right thing to do since 2009. You had some rough years in there. 2015 was kind of tough. You had some problems. 18, 20 was kind of tough. Was it? I don't know. But what people have seen is that it's extremely easy to buy the dip in stocks. And however you do that, whether you're actually buying stocks on declines or you're selling puts or something like that, it's worked. However, we think we're in an environment where that's probably not going to work so reliably. And the best we think we can hope for here is probably a sideways market. And there certainly is the potential for this kind of bigger picture decline. And the reason we think this, there are a number of factors lining up, but one of the biggest is this pullback. It's a completed pullback, but it's a pullback. I told you at the beginning here, we trade pullbacks and trends. We can trade beginning, end, and middle of trend. This is do I know that it is? I don't know. We'll discuss it in 2023. But this looks like the beginning of a pullback, or like a pullback that'd be at the beginning of a downtrend. So I don't think that it is at all a reach to consider that we might be at the beginning of a fairly significant decline. Here's another, perhaps more actionable pattern. The Japanese yen. I'll just highlight some other pullbacks, but the one we're looking at now is kind of a bigger picture pullback. This is not a pattern that I'm super crazy about, but, and sometimes as a trader, this is another element of psychology. I don't really want to short the yen here for a number of reasons. However, this is such a compelling pullback pattern. And there's also, I want to point out another thing, and we're intertwining here, right? Look how long this pullback lasted. Look how long this pullback lasted. Are there other good pullbacks here? Not so much, right? This one didn't really work out that well, but so now look at the length of this pullback. It's longer. By longer, I mean time. There are more bars, there are more days in this pullback compared to these other pullbacks. This is one of the things that you will see. Like, you'll have a market that has these relatively short pullbacks. And then when you think it's exhausted, it goes into this longer pullback. And those are the pullbacks. This additional time in the pullback kind of gives the market time to reset. I think it's a psychological reset. Remember, we were talking about that wool merchant. And I think if his prices got a little bit too high, and it's not this guy setting prices, it's the market setting prices, then prices probably don't have to come down too much before people are going to go buy more and push the price higher. But if prices got way out of control, then of course it's logical that we would need a bigger reset. So that is how I would read the action here. By the way, do you see this here also? So the link, this is back to our treasury pullback, and you can see, I'm not going to highlight every one of these, but you can see that this is a longer pullback in terms of number of bars in the pullback than what we've had in the past. So that's also why, even if you think we might be bottoming in treasuries, as you have this longer pullback, this kind of structure, that's why you might rethink that. And then here is for solar. So here's a pullback, right? And this is interesting where this occurs structurally, sitting on what is pretty obviously key support. So that's kind of a nice pullback when you have a market that bounces and then comes back and sits on support. That is a very typical setup for a break of that support. So this is how we would read that pattern. And one more, these are not actionable. This is the 5-minute chart from some of the include some of the overnight action. But I just want to point out that we've looked at daily charts, and you will see here many of the same patterns. Also notice, look here. Remember that pattern I showed you at the very beginning of when we started to look at patterns today, where we had that big shift in market character. Look at that. If you were trading this market and focusing on the short side here, this bar is a warning, kind of a punch in the face that you need to be careful. This is similar also to what we saw at the, so you know, here's a little bit of homework. Look at this chart and look at it against that daily chart of the S&P in the COVID decline 2020. Look at this. It's not, you're not going to line them up and see that, you know, see that they line up in any meaningful way, but the idea here is that this strength is similar. So that is the end of our slides. Let me just hit a few questions here. What's the percentage of bullish, bearish bars in the S&P 500 you consider our edge? Yeah, I guess you're asking maybe about quantitative testing. You just average, you know, you can look at the data set you're looking at and average it there. I have to look over here to read the question. If I enter a position and it has very good follow through in the morning session, do you adjust your stop in the afternoon or wait until the market closes? So this is a trader who's talking about trading on daily bars. Typically what I would do is wait until the end of the bar. That is a discipline that I have maintained whether I'm trading daily bars or weekly bars. And let me tell you, that's tough, right? Because Tuesday, yeah, if you have a big move on Monday, you're going to be tempted to adjust that stop on Tuesday. I probably wouldn't. What I would do is have a disciplined rule set for how and when I would do it, if I am going to do it. And you know, it's relatively easy if you're a day trader to only adjust like at the end of a 3-minute bar, 5-minute bar, but for whatever time frame, you pretty much want to wait for bar completion. There might be exceptions to that. If you have an exceptional move, there's some justification for, you know, like if you have a 3 or 4 times average size move, there's some justification for adjusting there. Most of my losses come from cutting early losses. Well, I would look at that in your trading record. The small losses do indeed add up quickly. This is a topic we're going to cover when we start focusing on entry techniques. So that is a good place to wrap up today. Like I said, I'm excited about the session. I'm excited about all of these sessions and very excited to have you with us. If you have questions, email us questions. We will do a little bit more extensive Q&A at the end of the next session, and we'll see you back in 2 days, same time, Tuesday. Thank you, everybody.